Back to today's market rally. Through the Cycle founder, John Lonsky, and Market Gauge Group Managing Director, Michelle Schneider, joining me now for details on what the heck is going on. Good to see you both. Jonathan, I want to go to you first, John. Today's action, and particularly look at the NASDAQ. It's up 3.5%, but it is important to keep in mind that the NASDAQ is down about 30% over the past year. I mean, I'm very heartened that it's making gains today, but it's got a long way to go, no?
Yeah, I think it does. And I think, to get back to where it was previously, my goodness, you're looking at about a 40% gain. Right now, we're reminded that, dead cats bounce. And I might add, dead old bulls also bounce too with the NASDAQ. It's not coming back to its highs anytime soon. We have to get this cycle of Fed tightening out of the way. Better yet, we have to get the upcoming recession mostly out of the way. I think that is inevitable. What we don't know is how much damage that is going to inflict on the economy.
Michelle, what apparently we do know is that this is a worldwide recession we're looking at. Some people say that one reason the markets are up is because the UK has announced that they will go ahead with tax increases, or at least keep taxes the way they are. Frankly, I don't think that's good news. Do you?
Well, what's so interesting is that really if you walk away from the tax conversation, just look at the currency conversation. That's what I'm really very focused on right now. Besides the obvious things that David pointed out, the way the Fed goes with yields, et cetera. But if you look at the currencies in the euro and in the British pound and the Japanese yen, they have sent really big shock warnings to not only the investors, but also the whole government structure there. And right now in the U.S., we're looking at the dollar, which has been so strong relative to those currencies that really right now what I'm watching for is, can the dollar sustain these high levels? And if not, then whether it's taxation or anything even that the Fed might do to try to soften things up here, we could still be in for some really hard times. Let's put it this way. This doesn't look like a bottom. It looks exactly like what David said, a dead cat bounce.
Okay, that was actually John who said that. But John, I want to bring you in here again. Okay. The fact is that I don't think there's anything good, particularly good, about taxes going up in the UK. I think the private sector is the thing that has to be strengthened, not the government sector. What do you think?
David, I think you are exactly right in the long run. Perhaps what is wrong in the UK is they're paying the price for a Bank of England central bank monetary policy in England that was too generous for too long and perhaps should be a little bit tighter right now. Higher interest rates in the UK, though they're high already, would help to strengthen the pound vis-a-vis the dollar. On the exchange rate front, I am especially worried about how the dollar has strengthened against emerging market currencies, where a lot of these borrowers in emerging market currencies have outstanding loans that are dollar denominated. So all of a sudden they find that in addition to interest expense, they're also having to come up with an additional payment for the degree to which their own currency has dropped against the dollar.
John, I want to stick with you for a second on something that's of great concern to all of us that are getting close to retirement age, and that's what's happened to our 401ks. Because not only are they getting a hit over 10% from inflation over the past year and a half since Biden came into office, but they're also down, as I mentioned, the NASDAQ is down 30%, the Dow is down less than that, but still about 10%. So you combine those forces together. New study, Steve Moore just came out with a study saying average retirement loss is 25%. Over the past year and a half since Biden took office. A 25% loss, that's $2.1 trillion. What do you say to the retirees or folks close to it?
Well, you're going to have to cut back on spending, aren't you? And that's going to help push us into a recession. This is very much a hot political issue in my mind. We have midterms coming up on November 8th, so it behooves holders of these 401ks to vote in a manner that would help facilitate a bottom for the equity market, a bottom for the economy, and a recovery by their retirement plans. And I don't have to add who you should be voting for on November 8th if you want to get out of the hole you're in right now as quickly as possible.
Well, Michelle, investors can also vote with their money, and a lot of 401k holders are maybe not as sophisticated as you folks are. But what should they do with their 401k? Just sit back and wait for the storm to pass, or should they get actively involved in moving some of their funds away from stocks?
Well, I think a lot of will depend on the age of who you are. I mean, if you're 60 plus and you're counting on that money to retire, then I would think that at this point now, if we can't get any kind of sustainable bounce, regardless of what happens at the midterm elections, you might really want to start thinking about pulling to cash or more fixed income, or even taking advantage of these higher interest rates. But if you're 35, 40 years old and you can afford to wait 10, 15 years, that's another story. Then at some point you'll start looking at stocks as, especially some of the big name stocks, as looking relatively cheap to where they can go to the downside. So for us, we've been recommending more safe fixed income, interest rate bearings, or cash for people who can still do that.
Go ahead, John.
And be very careful with your 401k. Make sure that you have a lot of diversification. You know, Michelle is right. Maybe you should sell some of your stocks and build up your cash holdings in the 401k. If you have a lot of exposure to just several stocks whose outlook isn't entirely all that rosy, that great, get out. Otherwise, if you have a lot of diversification, I will tell you, just wait out the storm. The storm may only last a year or two for all I know. It may not last 5 or 6 years, as was the case in the past. The important thing is we need changes in government policy and monetary policy to bring the U.S. economy back up to a sustainable rate of growth.
Well, as Larry Kudlow loves to say, the cavalry is coming. So we can only hope. Gang, thank you. Michelle, I'll see you in the next hour as well. John Lonsky, great to see you as always. Coming up, a wave of drones raining down on Ukraine's capital city of Kyiv. Why one expert says Putin is running out of options. That's next.